we were talking about adjustments on the accounting equation. So today we're taking those adjustments a little bit further, and we're talking about the statement of comprehensive income, which is also called the income statement. So we're going to look at how to prepare an income statement at the end of the financial year, and taking into account all those adjustments like the prepaid expenses, the trading stock deficit, the consumable stores on hand, all those adjustments that we did yesterday, and then we'll be entering them directly into the income statement. Okay, learners, but before we do anything, you've got to make sure that you know which accounts goes into the income statement. So you're going to look at your trial balance, then it will be separated between the balance sheet section and the nominal account section. Okay, so the balance sheet section normally contains all the assets, the owner's equity, which is called for capital and drawings. Those two are owner's equity accounts, and it will have the assets, the fixed assets and the current assets, long-term liabilities or non-current liabilities, and current liabilities. The nominal account section will normally contain all the income and the expenses. So the statement of comprehensive income will be used to compare the income and the expenses, because we want to determine what is the financial result of the business that we're doing. Okay, so the financial result will either be a net profit for the year or a net loss that the business has suffered for the year. So I need you to page to activity number 4 in your workbook. So if you have activity number 4, then you'll see what they're giving you is a pre-adjusted trial balance, which means some of these figures are going to change because of the adjustments. So on top you have your balance sheet section, and then you have your nominal account section. So all these accounts, the nominal account section, those are the accounts that are separated between income, and you separate them because an income has a credit total and all the expenses as debit totals. Okay, so the difference between the income and the expenses, that will tell you whether you're making a profit or a loss. And for that, we have to prepare the statement of comprehensive income, or which is also called an income statement. But together with this nominal accounts, there are a few adjustments, meaning that these adjustments, as we go through them from the letter A to I, these adjustments will have an effect on some of these accounts. So before we can close them off to the income statement, we'll have to change them, we'll have to adjust them, and then we send them off to the income statement. Okay, so when you look at the format of the statement of comprehensive income or income statement, we can say that it starts with sales, then we get cost of sales and gross profit. So what we should know, learners, is that the cost of sales total will always go in brackets. Okay, so you're going to have sales, cost of sales, gross profit. Then you're going to add your income, which you'll find in the credit column of the nominal account section. And then you're going to get your expenses, which will be all the operating expenses, which you'll find on the debit side. So we'll have to write in all those expenses. Some of the figures are going to change before it's entered. If the figure doesn't have an adjustment, then it goes straight to the column. Then obviously for that, we have to read through the adjustments as we go along. Okay, so let's just get that. Here you can see it says income statement for the year ended the 30th of June 2018. So what you should immediately know is this date is the end of the financial year. Okay. So your financial year will run from the 1st of July 2017 until the 30th of June 2018. So we want to find out how much profit are we making in that particular financial year. So anything that doesn't belong to that financial year, we will take it away. And if it does belong to the financial year, we will then just have to add it on. But before we do anything, there's just a general rule that you should know that if anything is accrued, then you will have to add, which means accrued income or accrued expenses, you will have to add. And if the item is going to be prepaid or received in advance, then you'll have to minus. So if you're looking for accrued, you're going to add, and then prepaid is going to be minus. Okay, that's just a general rule. So as soon as you can identify if the expense is accrued or prepaid, it's plus if it's accrued and minus if it's prepaid. Okay, so what we do is, and what you normally do is, as you can see that your first item in the statement of comprehensive income or the income statement is sales, then you take the sales figure and write it immediately next to that one. So I'm going to start with 492,700. And if I take my cost of sales, I'm going to take my cost of sales 263,300. 263,300. Okay, so now what I do, I look at the adjustments. Right, so the first adjustment, or adjustment A, it says a debtor Z SWAT returns stock with a selling price of 960. So the selling price is 960 and the cost price is 580, and no entry was made yet because this transaction was not recorded yet. So when a debtor is returning goods, will the debtor owe you more or less? If he's sending the goods back, he's obviously going to owe you less. So when you take your trial balance, and debtors control will appear in the balance sheet section, the debtor is going to owe you less, which means we'll have to take away, we'll have to minus 960 from the debtor's balance. Okay, so you have to minus 960 from the debtor's balance, and also you have to add 960 to the debtor's allowance balance, which means your debtor's allowance is increasing and the amount that the debtor is owing you is decreasing. Okay, so if I take that first line, that 960, debtor's allowance will normally go to your income statement on the first line. So I have my sales, and your first line is normally sales, that's the sales figure, minus the debtor's allowance. But because the debtor's allowance has an adjustment, we can't take 5,800 as it is to the income statement. We now have to take 5,800 and we have to take 960 to your income statement. So when you go on your calculator, we can say 5,800 plus 960, and that two together, 5,800 plus 960, that two together gives you 6,760. So this two together gives you 6,760. So now it will be the sales figure minus the new debtor's allowance figure. And then you're going to write them in your column for the sales. So that will come to 485,940. Okay, so what I did was I added the 960 of the debtor's allowance, and I take the new total of debtor's allowance to the first line. So it's sales minus the new total of the debtor's allowance, and I get my net sales over there. Okay, we're still busy with the first adjustment, because what is happening is there's a double entry that we have to make with the selling price of 960, and we have to make a double entry with the 580. When the debtor is returning the goods, the 960 will affect the debtor's control and the debtor's allowance. But the cost price of the goods, the 580, that's the cost price. The debtor is returning trading stock. So your trading stock and your cost of sales is affected. But with the 960, it was debtors control and debtors allowances. Okay. So now with the 580, we have to go and change the amount of the trading stock, and we have to go and change the total of the cost of sales before we can take it into the income statement. Okay, so when I look at my trading stock is over here. Let's get this. Here you go. My trading stock is going to increase with 580. Why? Because the debtor is sending the goods back to us, so now our stock will increase. The debtor no longer wants it for whatever reason, so now we have the 580. Then we cannot include the 580 in the cost of the sale. That is why you have to minus 580 from your cost of sales. That means your cost of sales figure is going to change before you take it into your income statement. So when we're looking at the income statement again, there's my cost of sales. So I can't take the cost of sales immediately. I will have to take away, I'll have to minus 580. And when I minus 580, then I'll get a new total for cost of sales, which will be 262,720. Okay. So the selling price of the return, you add that to debtors allowance, and the cost price of the return, you minus that from your cost of sales. Then you have the totals, you have the new sales figure, and you have the new cost of sales figure. That means you can calculate your gross profit. It's going to come to 223,220. Okay. Then we know, grade 10, that adjustment A has been completed because we worked with the cost price and we worked with the selling price. So we made a double entry for the selling price and we made a double entry for the cost price. Okay, so that adjustment A is done. Okay, let's have a look at the second adjustment. It says the tenant, so now I immediately know that my rent income is affected. Has paid the rent in advance for July. Okay, so what are we saying over here? That remember, I said your financial year starts the 1st of July and it ends the 30th of June. So that gives you a 12-month period. But now, he has also paid for July. He has also paid for the next month. He has also paid for the next month, which is July. So he has paid an extra month, or which means we have received the extra month, which means we must have received 13 months. So if I look at my total for rent income, now your rent income will appear under your income. So now we have to write it in. We have to say rent income. And your total for rent income, you'll find in your nominal account section, there's the rent income. So your starting point in your income statement is going to be 16,900. So if we have received more than what we're supposed to have received, then it's going to be received in advance. And if it's received in advance, we're supposed to minus. So what are they saying? Is that amount of 16,900. So your 16,900 is actually 13 months. That's what we're saying. So we want to determine what is the rent for 1 month. So if we take 16,900, just check on our calculator, divided by 13, I get 1,300. So it's 1,300 per month. That was received in advance. We received the money, but we haven't earned it yet. That means we have to take away 1,300 from the total because it was received in advance. So you have to minus 1,300, and then you get your final answer, which is 15,600. So your final answer will be 15,600. You can also look at it as follows. If that is 13 months, and this is 1 month, that means that this amount will have to be 12 months because the tenant has rented the place for the whole year from the 1st of July till the 30th of June. That's the 12 months, and he paid for July 2018, which means he paid for 13 months. That is why we have the 13 months, and the amount is 16,900. Then you have to minus, and then you just write it in. Okay. Then the next space there, grade 10s, is just to check if there's any other income that's also listed over there. But now you must remember, the income is the nominal credits, but interest income does not go by the normal operating income, and interest expense doesn't go by the normal operating expenses. Because of the materiality, we have separate lines for interest income and interest expense on the face of the income statement, which means there's the line for interest income and there's the line for interest expense. Because it's interest, you always have to show the interest and not part of the normal operating expenses or part of the normal operating income. You do not include interest income under the income section of the income statement or the operating expenses. There are separate lines at the bottom part of the income statement for interest income and interest expense. Okay, so when we look at your trial balance and we see, okay, there's the rent income. That is the one that we did already. Then they've got interest on fixed deposit, which is the income, but I cannot write it there. Then they have more interest, and they have more interest, and in the very last item there, they have bad debts recovered. So just for completeness, what I can do is I can complete the top part of the income statement by just writing in bad debts recovered. Now, because bad debts recovered doesn't have an adjustment, I'll write the figure in as it is, straight from the trial balance, unadjusted. Meaning, take the figure of 1,440 and write it in your income statement immediately. It doesn't have, oops, let me just check. I did not check if it has an adjustment. So I must start here, 1,440, and then I must go and check to see if it has an adjustment. Oops, I did not check that. I did not look under the adjustments. Okay, there is an adjustment for bad debts recovered, but let's do them according to adjustment, and then we'll get to that one when we get there. Okay, so far we've only done adjustment A and adjustment B, so we can just tick those two off. Okay, and if we'll have a look at adjustment C, adjustment C talks about a physical stock taking that was done at the end of the year, and it showed that we have trading stock of 29,000 and we have packaging left of 540. Now what that means, those two figures is after the physical stock take that we had. Our books is saying that I have trading stock of 31,440, but that figure was adjusted, so I will have to take the 31,440 and add 580. That's how much my books are saying. And then when I went to go and count, I'll see that I only have 29,620. So when I go count, I see I only have 29,620, which means I have less stock than what my books are saying. So now I have to go and adjust my books, and that stock that is missing or stolen or for whatever reason it is gone, I call that trading stock deficit. So under my operating expenses, I will have an item called trading stock. Now, trading stock is the asset that does not go to the income statement. Trading stock deficit, that is the expense, that is the loss. Now that goes to the income statement. Now I have to explain how I get the trading stock deficit. So normally trading stock is just the difference between the trading stock that you have in the trial balance, which is 31,440, but I had an adjustment. I had to add back the 580. So what 580 was that? That was the 580 that the debtor has sent the goods back that he no longer wants, that we did by adjustment, the first adjustment. Remember, when we had to minus it from the cost of sales and then we had to add it to trading stock. So that is that 580, right? And then we have to big minus the amount that they give me in your income in the adjustments, which is 29,620. So it's going to be first add that to, then I minus the figure that they give me, then I will get a deficit of 2,400. So my deficit is 2,400. But I first have to add the 580, then I have to minus the 29,620. If the 580 was not there, meaning that there was no adjustment A, then the deficit will just be the difference between the trading stock and the 29 and the physical account. But because there was a return that debtor send the goods back, I first have to add the goods back, then I have to minus the physical account to determine the deficit. Okay. Then still by C, they're talking about packaging, so I might as well identify the packaging. So I need to write in the packaging or packing material. In this case, they call it packaging. And the packaging total that we get from the trial balance is 3,600. Now that is the figure that the pre-adjusted trial balance is telling me. That means I've spent 3,600 on packing material. If I've used up everything, then the 3,600 will be my expense for the year. So I need to check what does the adjustment say in regarding packaging. So it says a physical stock taking has revealed the following on hand, which means you have packaging left. So it's a consumable store on hand. So that is the packaging that you have left, which means you did not use the whole 3,600. So we want to determine what was the amount of the packaging that we have used. If it's 3,600 spent and 540 left, so we have to minus the 540 to get the amount of packaging that was used, and that will be 3,060. Okay, which is a fairly easy adjustment. It's just the packaging amount minus the amount that we haven't used, and that is the amount used. So this is the amount on hand. Oops. That's the amount on hand. And this is the amount that we have used. So if the adjustment says packaging used, and then you know it will have to go into your column by the expense. So that will be the expense because that is the amount that we have used. Although we spent 3,600 on packaging, but we've only used 3,060. Okay, that was adjustment C. So let's just tick them off quickly so that we know, right? We've done A, we've done B, we've done C. There's nothing to come back to because we have completed them. So there's nothing over there. Right, adjustment D, grade 10s, is talking about advertising. Advertising is an expense. So what I do, I write my advertising in. And I start with my advertising with 11,900. So where do I get the 11,900? I get that straight from the advertising 11,900. That is the figure. That's how much I spent on advertising for the year. Whether I've used all the advertising or whether I've used too little advertising, that the adjustment will tell me. So what does the adjustment say? It says included in advertising is a payment of 2,400 for 2 adverts. Okay, so it's 2 adverts, 2,400, which means 1,200 each. Because 1,200 times 2 will give me the 2,400. The 2 adverts, one was for June and the other one was for July. So June is the end of our financial year, so we need that one. And July is the beginning of the next financial year. So I've paid advertising for the next financial year, which means the amount for July is then prepaid, which means that 1,200 that I've paid, that's included in there, does not belong to this financial year. So that will be a prepaid expense, because I've paid for something, but I'm only going to use it in the next financial year. That means it doesn't belong to this financial year. So earlier we said that as a general rule, if the item is accrued, we're going to add, and if the item is prepaid or received in advance, we're going to minus. Now we have the item, one of the items in advertising is prepaid, so now you have to minus. So now you have to be careful, grade 10s, you only have to minus the month that does not belong to this financial year, which means you only have to minus one advert, because that advert is applicable for July and it doesn't belong to June. Right? So it's going to be 11,900 minus 1,200, which gives you 10,700. So the advertising for the year, or the advertising expense for the year, is 10,700. Okay, which made it easy. Let's just go over that one again, just so you can identify where does the 1,200 comes from. It was 2,400 for 2 ads. Okay, so one advert is 1,200, and that one that doesn't belong to this financial year, it's paid for the next financial year. That one is prepaid. That is why you have to minus the 1,200 from the advertising. Okay, that's not so bad. Let's have a look at adjustment E. E talks about telephone. Okay, so telephone is an expense, so we're busy with E. So telephone is an expense, so I just have to go to my income statement quickly and write down the telephone amount from the trial balance. So now I have to write the telephone, and the amount in the trial balance for telephone, here you can see it's 3,990. So that will be my starting point. So it's 3,990. So if the telephone is prepaid, then I have to minus. If the telephone is accrued or it's outstanding, we've received it, but we haven't paid it yet, then I will have to add. Okay. What does the adjustment say? And that is the thing that will tell you whether the expense or the income is prepaid or accrued. It says the telephone account, 635 Rand, has been received, but it's not yet paid, which means we still owe the telephone, so that will be accrued. So therefore, we have to add. Okay. So let's add the 635 to the telephone. So we have to add 635. And then we'll get a new answer for the telephone. So it'll come to 4,625. Okay. So there you can see the difference between if the item is prepaid, we have to minus, and if the item is accrued, you have to add. Prepaid you have to minus, accrued you have to add. Okay. Let's just tick off adjustment E. Okay. In adjustment F, it's talking about insurance. So the first thing I do, I go write in my insurance in my income statement. So it's insurance. And my opening total for insurance is 5,300. It's an expense. So if it's prepaid, I have to minus. If it's accrued, I have to add. Okay. Again, the adjustment will tell me whether the item is prepaid or accrued. So let's just put this one side quickly, or we can just use this quickly. What does it say? It says insurance includes an annual amount. Okay, let me just underline the important words here. Insurance includes an annual. So the word annual tells me immediately it's 12 months. Okay, and it was paid on the 1st of November 2017. So let's draw a timeline for this one so that we can get our timeline. So we said the financial year starts the 1st of July 2017. It ends the 30th of June 2018. Okay, so now what happened? On the 1st of November, 2017, we paid an annual amount, and that annual is going to end on the 31st of October. So all the months after June until the 31st of October is paid for already. Right? Because you paid it in November and you're paying for 12 months. So your 12 months, or they say it's an annual. So your 12 months is going to end on the 31st of October 2018. So all these months is paid for already. So that is prepaid. So now I need to determine how many months is prepaid. But what I know is it's 1,200 for the year. So I need to count. It's for July, then it's for August, then it's for September, and for October. So if my year ends the 30th of June, then that one is for July, that one is for August, that one is for September, and that one is for October. So 4 months of that 12 months is prepaid. So I take my 1,200 and multiply it with 4 over 12, and I'll get 400 Rand. So the amount that is prepaid is 400 Rand. Okay, let's just pause there a bit, and you can take that in quickly. 12 months, 1,200, July, August, September, October. The 4 months is prepaid. So now I have to minus 4 months that's prepaid from the total in the income statement. So let's just have a look quickly. So it says for insurance, I have to minus 400. Right, and then the total answer will become 4,900. That is my insurance. That is normally an adjustment that you have to just check to see, and sometimes you will have to draw your timeline just to make sure that you know how many months is paid for, and that's the number of months that falls outside the financial year, and those are the amounts that is prepaid. Okay, so that's how your insurance will look. That is how the adjustment for insurance will look. We know it's 4 months prepaid, so that is what we have to take away from there. Okay, so that was insurance. So let's just tick off insurance. Okay, now, adjustment G talks about interest on fixed deposit. So it's also saying, remember, it's interest, and it's interest on fixed deposit. So it's an income, but It does not form part of the normal operating expenses or the normal operating income from the business. There's a separate line at the bottom of your income statement for interest income, and that one denotes that we have to do note number 1, and we only take the final total into that particular place for note number 1. Right? Then obviously this will be note number 2. So it will be interest income, and then interest expense will be note number 2. But the interest expense note is not required in this exercise. We only have to do the interest income note. So what does the adjustment say? It says interest on fixed deposit for the entire year is still owing, which means we haven't received any interest on fixed deposit. So how do we know? There is interest on fixed deposit. What does it say? Interest is still, you must still receive some interest. Interest on the fixed deposit for the year is still owing. Although we have received interest, we haven't received all the interest. And it says interest on the fixed deposit is capitalized, which means the interest that you receive gets added to your fixed deposit. So if there's an item, fixed deposit, whatever interest we earn gets added to that opening, to that total, which means now we will be earning interest on interest, which is like compound interest. But the calculation will just be a simple interest calculation. So here we already have interest on fixed deposit, but the adjustment doesn't say interest is outstanding for so many months. But although we know that we have received, it doesn't say for how many months we have received or for how many months we must still receive. But what we can do, we can go and calculate how much interest we're supposed to receive for the whole year. So it's interest on fixed deposit. We can go and calculate how much interest on fixed deposit we receive for the whole year by just doing a simple calculation. We just have a look at the fixed deposit, which is 23,000, and I'm supposed to earn 15% per annum. So I'll just have to multiply 23,000 times 15%, and I'll get the interest for the whole year. So let's just have a look at this quickly. I'll just put the calculation next to it. So the fixed deposit is 23,000, and I'll just have to multiply it with the percentage times 15%. So now I don't need the 12 over 12. So 23,000 times 15%. That's going to give me 3,450. Right, so that will be the interest I'm supposed to receive for the whole year. But let's just start here quickly, 3,100. So now I can see I have received 3,100, but I was supposed to have received 3,450, which means the bank, they still owe me interest of 350. So this is accrued income. They did not ask us to calculate that. I'm just putting the calculation just for completeness so that we know 3,100 plus 350 gives me 3,450. So that will be the interest. So while we're here at the bottom for the interest, we might as well write in all the other interest that doesn't have adjustments, which in this case, it's just interest on the current account. And that interest is 890. And interest from the overdue debtors. That's the interest that we charge the debtors because they're not keeping the accounts up to date. So we charge them 1,155. And just to get that total, that will give me 5,495. Okay. So the total interest income for the year is made up of the interest of fixed deposit for the whole year, plus the interest on the current account, plus the interest on the overdue debtors. So it's 5,495, and that amount will have to transfer to your income statement, but at its correct place, which is 5,495. Over there is a separate line for interest income. So that note says, number 1 says, refer to note number 1, so that you know how we got that amount. So that will be the interest income for the year, and you place them at the bottom because of materiality. So we're not using the interest, and it does not form part of the interest above. Okay, so that was G. So adjustment G is done. Okay, then let's have a look at H quickly. It says R Green, whose account has previously been written off, paid 20%. Okay, so let's just calculate quickly. What is 20% of 400? And that gives me, yes, 2 times 4 gives me 8, so that will just be 80 Rand. So we have to work with the 80 Rand. Now what does it say? It says that he paid 80 Rand on the 25th of June. If the person comes, if we wrote him off, and he comes back to pay, then we call it bad debts recovered. And that will be an income. So your bad debts recovered will be an income, which means it will not go over here. Okay? So let's have a look at how that will affect the bad debts recovered, which means, that was the one that where we jumped the gun a bit, where we thought there was no adjustment for bad debts recovered, and there actually was adjustment for bad debts recovered. So what happened was, it says that we received the money, but it was erroneously entered into the debtor's control, which means that we've received the money from the debtor, but he was no longer a debtor because we wrote him off. He was classified as a bad debt. But then because we put the item in the CRJ in the debtor's control column, we went to go and minus 80 Rand from there as well. So we weren't supposed to classify it as a debtor, we were supposed to classify him as a bad debts recovered, which means our bad debts recovered is going to increase. That is why we have to add on 80 Rand over here. We have to add 80 Rand. Now what we need to do, we need to be very careful with this one. It is not an accrued expense, because bad debts recovered, first of all, is an income, and it's not an accrued income either. Okay? Let's just plot to see what has happened so that we can follow. Okay? There's my bank account, quickly. Here's my debtors control. And here's my bad debts recovered. Right. We received 80 Rand, which is right. We were supposed to take it to bad debts recovered. We were supposed to post from there. We were supposed to post here. We were supposed to take it there. But we did not take it there. We took it here. Now that was the mistake. We weren't supposed to take it away from. We took the 80 there and we took the 80 there. We weren't supposed to do that. That was wrong. We were supposed to take it there. This is right. That one is right. Okay, so what we're supposed to do now is we have to cancel, or we have to fix our mistake. We have to add 80 back to debtors control, and we have to add 80 back to bad debts recovered. That is why when we do the adjustment, there is an opening total, so we have to add 80 there. Then it will become 1,520. That will be the bad debts recovered total. So please, it's not an accrued income, because the double entry will be debtors control and bad debts recovered. Okay, so it's not accrued income and bad debts recovered. Then also in the trial balance, next to your debtors control, we have to add back 80 Rand, because we had to, early on we went to go in minus 80 by mistake, and we weren't supposed to minus over there. So now we have to add back 80 Rand over there. Okay? Although that does not affect the income statement, but just for completeness, I just want to make sure that we have all the items that was adjusted correctly. Okay, so that will just be that will be that 80 over there. although that 80 does not affect the income statement, this 80 over here, the double entry for the previous 80, that affects the income statement. In there you can see that we have all the income, so we can get a total of the gross income. So just for completeness, we can do that quickly. So let's just add. So that gives me 16,000, 17,120. So it's 17,120. Then I've got the total of the gross profit plus my total of the operating income. So I can get the total of the gross income, which will this be 240,340. So I've got 240,340 as the total of my gross income. So that one is done. So then we just have to look at the other part of the income statement. Then we just have to look at which items that we must still go and adjust, and then we'll be done. Okay, so the next adjustment that they're talking about, so let's just do this quickly. Right, that one is done. Right, so the next adjustment is talking about depreciation. That means depreciation won't appear as a line item under the nominal account section because we won't be able to pay for that. Depreciation is an imputed expense. It's not a cash item. It's an expense that's incurred for the use of our fixed assets like your equipment and your vehicles. So depreciation is the wear and tear that we have to write off every year based on the usage of your fixed assets for vehicles and equipment. And by now we should know that there are two methods. So what we're going to do, we're going to have the line item over here, depreciation. And we're going to split them between vehicles and equipment. Or we can first do the vehicles. That part will then just be the vehicles, and then this part will just be the equipment, but we'll have to add them together, and then we'll have to write them. Sometimes there will be a separate line for depreciation on vehicles and depreciation on equipment. So let's just see what does the adjustment say quickly, and then we've got it made. Right, they're talking about vehicles. It's 20% per annum on the diminishing balance. Okay, then also it says, right, so let's just do that quickly. Let's just go to vehicles. Okay, there's my vehicles quickly. Right, there's my vehicles. And I need my accumulated because they say it's diminishing balance. So those are the two figures that I'm going to need. So I need 150,000. Okay, and the accumulated on the 150 is 26,400. Okay, so let's just say, what does it say? It says 20% per annum on the diminishing balance. A new vehicle costing 40,000 was purchased on the 1st of January. Right now, grade 10, this part is very, very important for you. It says that we have a new vehicle, which means my 150,000 is going to be split between old vehicles and new vehicles. But what is very important is the next sentence. We know the new vehicle is 40,000, and they give us the date that we purchased the vehicle. What we need to determine is the new vehicle included in the 150? So I need to read this sentence. It was properly entered on this date, meaning that the 40 is included in the 150, which means the old is only 110,000. And this was bought on the 1st of January 2018, and our financial year is ending the 30th of June, so I only have it for 6 months. This one I have the whole year, but there's accumulated attached to it of 26,400. So I need to calculate the depreciation separately on this one and separately on this one, and then I will have to add that two together. Okay, so let's just do this on the calculator quickly. Let's just see what they say. So it's 110,000 minus 26,400. That gives me 83,600. Now I have to multiply that by 20%. Gives me 16,720. That's the depreciation on the old. Then on the new, 40,000 times 20% times 6 divided by 12. That gives me 4,000. Right, so that's 6 over 12 times 20%. Gives me 4,000. So that depreciation together gives me 20,720. So then I have to enter that into my vehicle. So it's going to be 20,720. I can write them separately, or I can just write them as one figure. So it will be 16,720 plus 4,000. That gives me 20,720. Okay, that will be the one depreciation. So let's just have a look quickly just to see how we calculate the depreciation on the equipment. So it's exactly the same. We just need to read very carefully to find out, was it recorded or wasn't it recorded. It says equipment is 10% per annum on the cost, which is an easier method. So I don't have to minus anything, so I don't require the accumulated. So the equipment is 26,500. So the equipment is 26,500. Okay, so I will still have to split, but I need to find out what does it say. Additional equipment with 6,000 was contributed by the owner on the 1st of May. No entry was made, which means I have new equipment of 6,000 and I have old equipment of 26,500. So I just need to multiply that with 10%. That is going to give me 2,650. I need to multiply that with 10%. And I need a fraction here because the owner gave it in May. So I only have it for May and for June, which is 2 months. And I'll just have to add those two figures together. That gives me 100 Rand. So that comes to 2,750. Then I will have to enter 2,750. I can do it separate. So it's 100 on the new plus 2,650. Then I will have to add them together, which is 2,750. We'll have to add that together. Then the depreciation becomes 23,470. Okay, so that grade 10 does all the adjustments. But what's still very important that we didn't do today is those items that appear in the nominal account section. So we have to look for items in the nominal account section that we haven't used. For example, salaries. That item goes into your income statement and it does not change, which means we have to write in salaries 160,000. And any item now that doesn't have an adjustment just goes into your income statement just like that. Like bad debts, for example, did not have an adjustment. So we have to write them in just like that, 3,740. I think there's one more, salaries, that was bad debts. No, that was it, I think. It was salaries, bad debts. We did the interest, water and electricity, had an adjustment. No, so it's water and electricity. That was 3,385. Right, so all you have to do, grade 10, you will make sure that you understand your adjustments and write them over into your income statement. The only thing left for us to do is like to put the totals, and we just have to go through the process. But just remember that we have to minus the operating expenses. I thank you very much for attending today and watching. I hope the way to fill in the income statement has helped you a bit and you have enjoyed the lesson. Thank you very much for tuning in. Goodbye.